Add your son's name to the deed of your house so he can skip probate, and the day your family is forced to sell it while you are still alive, the IRS may hand him a tax bill of $52,500 for a house he never needed to own. Not a mistake he made, not a debt he took on, a signature you asked for, meant to protect him. And it does not stop at one tax bill. It can keep a hand on this house's sale, its refinancing, and your own Medicaid planning for as long as his name stays on that deed, because the deed change you signed to dodge probate does something else at the exact same moment. It creates a real ownership share today while you are still alive. And the tax code treats a lifetime gift and an inheritance as two completely different events with two completely different price tags. Not because anyone did anything wrong. Because the clock the IRS starts on a gift begins the day you sign. The clock it starts on an inheritance only begins on your last day. Sign today, and your child gets stuck with your original purchase price as their tax cost, what the tax code calls carryover basis. Wait, and they receive the date of death value instead, often wiping out the entire difference for federal capital gains purposes. That gap, between what he owes if you sign now and what he owes if you wait, is exactly what the next 15 minutes walk you through, along with the two tools that close it without you giving up a thing. I am your guide to real-world retirement and estate decisions, the ones that quietly decide what your family keeps and what the IRS takes instead. Quick favor before part 1. If catching a mistake like this before it costs you is useful, tap like and subscribe now so the next one finds you. Part 1. The ownership you just created. Here is how this plays out for a real family. Ruth is 74, widowed, and bought her house in 1994 for $150,000. Today, it is worth $700,000. A friend at church mentioned that adding a child to the deed skips probate entirely, so to avoid a court process and make sure her son Mark gets the house without a fight, Ruth pulls up an online deed transfer form, pays a filing fee under $200, and adds his name as a joint tenant with right of survivorship. No attorney. No money changes hands. It feels like paperwork. It is not paperwork. The moment Mark's name goes on that deed, Ruth has made him a gift of half the house, valued at $350,000, half of today's $700,000. The 2026 annual gift tax exclusion is $19,000 per recipient. Everything above that, $331,000 in this case, gets reported to the IRS on a Form 709 and counted against Ruth's lifetime gift and estate tax exemption, which sits at $15 million in 2026. No check gets written today for most families who have not already used up that lifetime exemption, but the gift is now on the record, permanently. And that form is not what actually costs this family money. What costs them money is what happens to Mark's tax basis, and that's next. Here is the part that actually costs the family money. The IRS has a rule that keeps the giver's old purchase price stuck to a gifted property, Section 1015 of the Internal Revenue Code, if you want the citation, but the plain version is simpler. Your basis, the number used to calculate your future taxable gain, is not the value on the day you received the gift. It is the giver's original cost. Mark's basis in the half he just received is half of what Ruth paid in 1994, $75,000. Not half of $700,000, half of $150,000. Say Ruth also replaced the roof and remodeled the kitchen over the years. Real capital improvements that raise her adjusted basis a little to $80,000 or $90,000 instead of exactly half her purchase price. That changes the exact number. It does not change the shape of the problem. 8 years later, Ruth's health declines and she needs memory care. Care in her area runs $6,000 a month, and her savings will not stretch far enough on their own, so the house has to become cash. The family sells it, now worth $850,000. To help pay for it, while Ruth is still alive. A sale during someone's lifetime never triggers a step-up in basis. That rule only fires at death. So here is Mark's exposure. His half of the proceeds is $425,000. His basis is $75,000. His taxable gain is $350,000. He does not live in the house, so the Section 121 exclusion that could shelter up to $250,000 of his mother's own gain on her half does not apply to a single dollar of his. He owes tax on the full $350,000 at a 15% federal long-term capital gains rate for illustration. His real rate depends on his total income, filing status, and state. That is $52,500. Owed by Mark. Out of his own return. For a house he never needed to legally own to eventually inherit it. Because here is what almost no family filling out that online form realizes. If Ruth had simply never touched the deed, that same forced sale would have been entirely her own transaction on her own tax return. Mark would have owed nothing, not a smaller bill. Zero, because he would not have owned anything yet. Ruth would still run her own numbers on that same sale. But that was always true, deed or no deed. Part 2. The Death Day Gamble. Say the forced sale never happens. Say Ruth keeps the house, still jointly titled with Mark, until the day she dies. There is a rule for exactly this moment. When one joint tenant dies and the survivor is not their spouse, the tax code starts from one assumption. The entire value of the property belongs in the deceased's estate. Not half. All of it. Lawyers call it Section 2040 of the Internal Revenue Code. That assumption can be overturned, but only if the estate can prove the survivor contributed their own money toward buying or improving the place. If Mark truly put in nothing, that proof can pull the full date of death value of the house into Ruth's estate, and Section 1014 can then step up the basis on the entire property, not just her half. In plain terms, if Ruth paid for everything and the paperwork can prove it, the carryover problem from Part 1 might disappear at her death. That is a possible outcome, not a plan, and it depends entirely on proof nobody in this scenario is collecting on purpose. Notice the word can, not will. This depends on documentation. Who paid the mortgage, the property taxes, the new roof, the furnace, across years or decades? Proving it usually means producing old bank statements or a mortgage paid entirely from Ruth's own account, with Mark's name never once appearing on a property tax bill or a repair invoice. Most families do not have a clean paper trail that old, or never thought to keep one, because they never knew this moment would matter. And when the records are murky, an executor or a tax preparer may take the simpler, more conservative route. Step up only the parent's half, and leave the child's half exactly where the original gift set it. Permanently at $75,000, no matter what the house is worth by then. An executor who guesses wrong here can carry their own liability to the IRS, so many choose the position that is easiest to defend on paper, not the one that would have saved the family the most money. So the death day version of this story is not a fix. It is a gamble, decided years from now, by paperwork nobody is keeping today. Part 3. What you signed away, starting today. Set the tax question aside completely. 4 more costs land the moment that new name goes on the deed. First, control. Ruth can no longer sell the house, refinance it, or take a home equity line against it without Mark's signature, because Mark now legally owns part of it. If he is slow to respond, out of the country, or simply hesitant, Ruth's own house is not entirely hers to act on anymore. Second, and the one families think about least, Mark's ownership share is now Mark's asset, and in many states it is reachable by anyone with a claim against him. A lawsuit judgment, a bankruptcy filing, a divorce settlement. Any of those can attach to his interest in his mother's house, and in the worst version, push toward what is called a partition action, threatening a sale to satisfy a debt that has nothing to do with Ruth while she still lives there. Third, and this is the one almost nobody sees coming: Medicaid. If Ruth ever needs to apply for long-term care Medicaid to help pay for a nursing home, the program looks back 5 years at every transfer she made for less than full value. And gifting half her house to Mark for nothing is exactly that kind of transfer. It does not disqualify her outright. It creates a penalty period, calculated by taking the value of what she gave away and dividing it by the average monthly cost of nursing care in her state. On a $350,000 gift in a state where care runs $8,000 a month. That math works out to nearly 44 months, well over 3.5 years, during which Medicaid will not pay for her care, counted from the day she actually needs it, not the day she signed the deed. A move meant to protect the family can end up delaying the exact coverage the family needs most. Fourth, the filing itself. Most families are genuinely stunned to learn that adding a name to a house is a reportable gift, a form, a deadline, a paper trail that follows them. You might be thinking none of this applies to your family. No lawsuits, no divorce, no nursing home ahead. Maybe not, but the carryover basis problem from Part 1 and the documentation gamble from Part 2 apply to every family that makes this move, lawsuit or not. Those two are not the maybe. They are the baseline. Part 4. The two tools that actually do the job. Ruth's goal was never complicated. Skip probate. Make sure Mark gets the house. Two tools do exactly that, without a single thing from the last 3 parts happening to her family. A transfer on death deed, where the state allows one, lets Ruth record Mark as the beneficiary directly on the title. She keeps full, sole ownership. No gift today, no Form 709, no loss of control, nothing for a lawsuit or a divorce to reach. At her death, the house passes to Mark automatically, outside of probate court. And because she owned it entirely, right up until the moment she died, the entire value gets a step up under Section 1014, without the Section 2040 proof fight from Part 2. Not a gamble. Not a documentation fight decided years later. A revocable living trust can do the same job for probate avoidance in every state and adds privacy if Ruth's plans or Mark's circumstances change later, but only if the house is actually deeded into the trust while she is alive. An unfunded trust skips none of this. The house still has to go through probate. Neither the TOD deed nor a properly funded trust creates the $350,000 lifetime gift described earlier, so neither starts that specific 5-year transfer penalty clock from Part 3. That is a different question from whether the house counts as an asset once Ruth needs care, or whether Medicaid can seek repayment from her estate afterward. Both follow their own state-specific rules, and Medicaid administration itself varies state to state. An elder law attorney in Ruth's state is the right person to walk through all 3 before she relies on either tool. Setting up a transfer on death deed typically runs a few $100s in recording fees. A properly drafted revocable trust usually costs more, often a few $1,000s for an attorney's time. Either way, that one-time cost is a small fraction of the $52,500 illustrative tax bill from Part 1. And it avoids creating the specific taxable gift that caused it. A simple will accomplishes the same tax result too, if Ruth would rather keep it that plain. It still goes through probate, the process she was trying to avoid in the first place. And probate cost and timeline vary a lot by state. For a single house with no disputes, it is often closing costs and a few months of paperwork rather than a courtroom fight, though some states make it slower and pricier than others. And because Ruth still owned the entire house until the day she died, the step-up under Section 1014 is exactly the same as with the other 2 tools. A will is the fallback, not the first choice, but it beats a lifetime gift on every measure that matters here. Run the same 8 years forward under either tool. Mark inherits the house at $850,000. His basis is $850,000. He sells it close to that same value. There is no federal gain left to tax on that sale, and no federal bill waiting for him. assuming he sells at or near what the house was worth on the day he inherited it, and setting aside his own state's rules. The $52,500 from Part 1 never happens. Not because Mark did anything differently, but because the paperwork never turned him into an owner before he needed to be one. Here is the one thing worth carrying out of this video. Don't use an ownership tool when what you actually need is a beneficiary tool. A deed change creates ownership today, with today's tax consequences. A will, a trust, or a transfer on death deed create ownership only at death, with the full protection the tax code reserves for that exact moment. If your goal is to skip probate, use the tool built for that job, not the one that happens to also do it, at a much higher price. This is not financial advice and not legal advice either. It is a reason to make one phone call before you sign anything. These rules depend on your state, how the property was purchased, and your family's own paperwork. Talk to an estate attorney before any name goes on any deed. That conversation costs far less than the tax bill it can prevent. If this saved your family a conversation you did not know you needed to have, tap like. It puts this in front of other families about to make the same well-meant mistake. Subscribe if you want more of these decisions laid out plainly. And type the word deed in the comments. It tells me this reached you, and I read everyone. Protecting your family is not about the fastest signature. It is about the one that actually holds up.